Good morning, John.
Hi, James. Thanks for having me.
Thank you for doing this.
Sure.
As usual with these things, I'm going to let you talk first. Just tell us a bit about Impact Space, and then we'll come to some questions. And if you've got questions, please put them into the chat function in YouTube. Over to you, John.
Fantastic. Great. Thanks a lot, James. So first up, a couple of compliance slides, which we'll take as read. But if we go straight on, first of all, just on the team, to introduce myself. So my name is Jon Forster. I'm co-portfolio manager for Impax Environmental Markets. I joined Impax in August of 2000. I've been working with Bruce for 24 years, focused exclusively on investing in environmental markets. I do believe that it's one of the most compelling investment opportunities out there, and currently out of favor. Outside of that, we were joined by Fotis getting on for 10 years ago now. He did a fantastic job on picking stocks and joined us as a portfolio manager 3 years ago. But it's not all about us. We've got a fantastic global platform for research. You can see we've got 51 analysts and portfolio managers looking at stocks. We're supported by various other teams, which takes the total investment team up to 85, which is present in Europe, the US, and also over in Asia. So very pleased and proud of the team that we've assembled over the years to help people get exposure to this environmental market story. So that's the team. If we move on quickly to the snapshot. So what is Impax Environmental Markets, and what is it trying to achieve? So it's a trust that's looking to provide investors with exposure to the growth of environmental markets. So in terms of what we're trying to achieve, it's all focused on growth and performance. We do have a significant net environmental benefit that you could attach to an investment in the fund, but just to be clear, the focus is on performance. Outside of that, we're invested globally across a diverse range of environmental markets you can see on the right. In terms of focus, we feel the trust is pretty unique with its small and mid-cap bias. We're only investing in proven profitable businesses, but it's $13 billion of weighted average market cap. So it's at the small end of the scale, which is quite unique in the market. As I said, it's very pure exposure to this growth opportunity. There's a minimum of 50% environmental revenues in any holding. And if you looked at the average in the portfolio, it would be 75%. So again, pure exposure to environmental markets growth. Outside of that, well-diversified portfolio of around 60 stocks. In terms of assets, we've got 1.1 billion pounds of assets under management. So it's large and relatively liquid. We have an excellent board, which went through a big refreshment cycle recently. So they're very engaged and chaired by Glenn Suarez. Outside of that, I'd just mention in terms of discount, the trust trades on an 11% discount to NAV currently. The board has been very proactive on buybacks recently. And so that's kind of where we are on discount. Outside of that, in terms of gearing, we've got about 7.5% of net gearing in the trust at the moment. Sorry, that number's missing. Obviously, that's a feature of trusts. We did take the gearing up a notch just over a year ago, and we expect that to contribute to performance over the long term. So that's the overview. If we jump to the next slide. So just quickly on the thesis of environmental markets, the overarching thesis is that in a world with growing populations and rising living standards, this creates a kind of ever-rising demand for growing demand for products and services. Against that backdrop, companies that are providing services which enable the cleaner and more efficient delivery of basic needs like food, water, and energy, and companies that are helping to address environmental challenges like climate change, pollution, etc. Our feeling is that these companies are going to grow earnings faster than the global economy, and that we can translate that to long-term outperformance of global equities. The other way to think about it is this slide here, which we call a transition to a more sustainable economy. there are very potent drivers of that change, these disruptors that you see in the middle of the slide. So the falling cost of technology across environmental markets, you could add to that the emerging driver from artificial intelligence. That driver is definitely alive and well. Consumer preference has joined as a very potent driver for our markets over the recent years. So if you think the VW Dieselgate scandal, the war on plastics, etc., these are big changes in the global economy where we are investing in the companies providing the solutions. And then finally on regulation, we talk about a ever tightening ratchet of regulations across environmental markets. So energy efficiency standards only get tighter over time, and that's a very potent driver of growth. While we're here on policy, obviously there was a huge momentum on environmental policy as we came through COVID, the drive towards net zero, etc. So, have we seen some governments, some countries delaying some of these targets? Yes, we have. Our position is it doesn't change the destination of where the global economy is heading to, just the pace of change. Outside of that, we have the US elections, which we can talk about later if that's of interest. But again, that's not something that we are overly concerned about. So we can come back to that if we like. So that's the basic thesis. If we jump to the next slide, in the interest of time, maybe next one down. Just to look at, okay, so what are environmental markets? This is our classification system, which breaks it all out. So a quick run through. So we have the energy sectors, which comprise the renewable energy markets, but also, more importantly, energy efficiency, which is everything from the grid investment, energy storage, industrial energy efficiency, a broad range of markets we can invest in. We have clean and efficient transportation, which in particular includes the electric vehicle opportunities. Smart environment is quite dominated by what we call digital infrastructure, which is all about our artificial intelligence exposed names. So there is some hardware in there, but also a lot of industrial software, which is improving the efficiency of industrial value chains. We've got water, treatment and infrastructure. We've got a diverse range of opportunities around what we call the circular economy. That's everything from product design software to sustainable materials to sharing economy business models like equipment rental to then waste management and recycling at the end. And then finally, sustainable food and agriculture is a group of sectors that are improving efficiency and reducing the environmental impact of what's a very resource-intensive activity. And again, it's very diverse, from sustainably managed forestry to natural and organic ingredients to fiber-based packaging. So I spent a bit of time just to give people a flavor of the spread of opportunity that we're looking at. If we jump to the next slide, take it a level down. In terms of universe, we're looking at this dark blue block within this slide. So we've got 1,500 names to choose stocks from, north of $6 trillion of market cap. So it's a large, rapidly growing, liquid universe to pick stocks from. If we then move on, so that's the introduction to environmental markets. If we turn briefly to performance, obviously a lot of numbers on this on this page, but if we maybe focus on the bottom, the key message would be that we'd had consistent, strong performance throughout the teens, which was driven by a kind of globalization of environmental markets and broadening spread of performance across the markets we've just discussed. We had standout positive performance between 19 and 21, contributed to by this drive towards net zero. That did leave some valuation challenges in some markets and a portfolio re-rating that left valuation at the high end in 2021. The last 3 years have been, that I'd say that left a difficult starting point for the last 3 years of inflation and rising interest rates. Obviously, that drove some rotation towards value, whereas our focus of the fund is definitely on growth, and it also created a much more difficult environment for small and mid caps. So I would say we've been here before in these periods of very strong out and underperformance. So I think that's probably all I could say on that. But if we zoom in a little bit on the next slide, this is a waterfall for the 12 months to June, which takes you from ACWI to the performance of the specialist strategy to which IEM belongs. You can see, just to stick to the key issues, key messages, a substantial headwind from not owning the mega cap tech, and also some puts and takes on environmental markets. We have had very strong performance in our digital infrastructure names and also in names exposed to construction activities. That's buildings, energy efficiency, and water infrastructure. In terms of the headwinds, we have some sectors that are suffering what we call temporary headwinds in their markets, quite often around destocking, but definitely starting to see some green shoots in some of those markets. So the renewable power utilities, or IPPs as we're calling them here, that used to be a much bigger headwind, but the performance has been better. I think it's also impacted by M&A activity within those markets. So private equity stepping up and seeing value in these markets. Secondly, we used to have a red block here for natural ingredients names that were also struggling through some destocking trends. Those names have turned the corner and would be sitting on the other side as a green sector. So some puts and takes, but the history is that as sectors work their way through these headwinds and turn a corner, that can unlock good performance. So that's just a bit of color on the more recent performance. If we go to the next slide, this is another way of looking at it. If you deconstruct performance and you strip out the dividend, you take account of the change in valuation. What's left is implied earnings growth. So we've done it over the medium term, let's call that 3 years, and long term over 10 years. And given the challenging period of performance, the message is that the implied earnings growth over 3 years has been very similar to global equities or ACWI, and has been actually kind of slightly better over 10 years. So typically a couple of points of extra growth. So, again, from a high base, we've been really struggling with this kind of relative derating over time. So that's that. If we go to the next slide, conscious of time. So this is a portfolio snapshot, well-diversified portfolio of stocks, diversified by sector and region, and with a good balance between more cyclical and more defensive stocks. You can see the weighted average market cap of $13 billion. And so this fairly unique focus at the small end of the scale. I'll leave that there. If we jump to the next slide on top 10, just to bring a few names into the piece. So DSM-Firmenich is one of our natural ingredients holdings. Again, it had some headwinds in some of its end markets, particularly areas like vitamins and animal feed, starting to turn the corner in those markets. It's also merged with another group called Firmenich, which takes them into natural flavors and fragrances, which is a compelling synergy opportunity, compelling cross-selling opportunity as well. So that is DSM-Firmenich. A second name, PTC, is one of our industrial software holdings. They're focused on product lifecycle management. That's basically product design software, manufacturing software to improve the efficiency of manufacturing. And it also ends up in capital goods. So you think of a machinery in a factory, it's involved in predictive maintenance. So forecasting when to replace components and avoid the machine breaking down. So that's what PTC does. And a final name, Clean Harbors, is the US market leader in industrial hazardous waste. It's a very highly regulated market. It's impossible to get a permit to open a new plant. So strong barriers to entry and some compelling growth opportunities through onshoring of manufacturing back to the US, the closure of captive treatment facilities within their industrial customers, and also this, PFAS, the forever chemicals that see quite a lot of profile in the press. That's a emerging opportunity for them. So that's what Clean Harbors does. So that's just to bring it a little bit to life on a few names. I think we'll take the trading activity as read, but I'm happy to come back to that in terms of what we've been up to, if that's of interest. But if we just jump to the outlook, most importantly, we feel the underlying thesis of environmental markets that we discussed earlier on is fully intact, but just out of favor. Secondly, on the macro side, the inflationary and rising interest rate environment has been challenging. We're looking forward to turning the corner and moving into a phase of falling interest rates, which should be beneficial for size and style. It is a very different portfolio compared to most other holdings, and we feel very constructive about growth and valuation. So I think that's what I'd say. I hope that wasn't too long. I think that's about 15.
No, perfect.
James, pass back to you.
Yeah, don't know, perfect. So good. Let's run through some questions. I think actually, let me leave it on this one or the one before. There's quite a big universe you've got here. Actually, let's go back to that slide. There we go. So yeah, 2,600 stocks. How do you whittle that down to come up with what goes into the portfolio? So what is it that you're looking for, particularly that would make one stock go in and another one not?
Yeah, we've got a very kind of defined and structured process for getting from a universe to a portfolio. So after you've created the universe, the investment team takes a look at the stock and decides, is it interesting? So what are we looking for? We're looking for growth. We're looking for a strong business model and strategy. We're looking for a management team with a proven track record. We're looking for strong financials, and we're looking for a name that we feel that the growth and margin outlook is not reflected in valuation. So that's what the pair of analysts will look for. Once the initial work has gone, we have a detailed due diligence phase that ends up in an investment committee where we decide, does this have the quality to go into portfolios? That's called a 10-step analysis. One of those steps is also an in-house ESG analysis to make sure we're comfortable on ESG quality. But that's what gets you to what we call our A list or approved list, which would be about 250 names. And that's what we're picking our portfolio from, is from that A list.
Okay, fair enough. If we then look at some of these sectors, where are we?
Yeah, you need to go up a bit.
There we go. So we've got specific questions on some of these. Firstly, solar, because I think when you were looking at the returns, there's the sort of a red bar for solar. What's the headwind facing that part of the market at the moment?
Yeah, I think solar would be probably the sector where the headwinds have been biggest and most long-lasting. So we can't say that sector is turning the corner. There's a few issues. First of all, there's been some regulatory change in the US, in the key Californian market, which caused disruption to growth in that market. High interest rates have been an issue in some markets in terms of denting the economics of solar. And the other thing is, it's like many sectors, they've been struggling with destocking. So there was a huge amount of inventory that built up both in North America and in Europe, and it's taking time for that inventory to flush through and get back to a normal market. So it's definitely taken longer than expected. But again, the cost of solar technology is very low these days. It's sometimes quite often the cheapest power you can generate. These issues will come to an end, but we're not, given the lack of transparency in the markets, we're not calling an end of that headwind yet, but we are keeping our holdings and following them closely on the way through. But that's what the challenge has been.
Couple above that, do biofuels stack up without subsidies, and are they actually just diverting resources away from agriculture?
Yeah, when it comes to biofuels, it's not a sector overall that we particularly like, because you tend to end up with reliant on subsidies. You're also exposed to completely uncorrelated commodities on the way in. So whether it's soybean or corn, etc., and then the bioethanol or biodiesel on the way out. So there are quite a lot of risks attached to that we don't really like. But what you can find is advanced biofuel companies that don't have those kinds of exposure. So Darling is a name that we own in the portfolio, which basically has a whole bunch of rendering plants in North America that treat butcher, abattoir, and bakery waste and convert that into advanced biodiesel. So that's a much more compelling opportunity with a better raw material source that's not exposed to the issues that you've highlighted. Does still have exposure to policy at the kind of end, in terms of the sale of biodiesel, but there's some quite interesting changes and drivers in those markets, like sustainable aviation fuel, which we think mean that's an interesting area for investment.
Okay, thank you. A lot of the portfolios in the US, does the election outcome worry you potentially? Is that something you need to focus on?
It's a good question. So I think the first thing to say is we have been here before. So when Trump was first elected, we had similar question of, is this the end for environmental markets? And over the following period, we actually significantly outperformed global equities. So obviously it's a very close race at the moment, and hard to call. But even if we take the Trump win as a scenario, we feel that I think everyone has got very negative what that actually means for environmental markets. So first of all, people worry about the Inflation Reduction Act, which targeted huge amounts of money into environmental markets. We don't see a full cancellation of the IRA. They might slow down. They're probably going to slow down the flow of funds into some markets, but I don't see a full cancellation of those markets of that funding. And it's definitely true that we can't say that Trump would be good for environmental markets. He's got a history of constraining funding to the EPA, etc. But federal policy is only one driver in North America. You do have a lot of state and local policy which remains supportive, and you do have a lot of corporate decision making, like the tech large cap names who are driving towards 100% renewable energy in their data centers. So it is something to monitor, but I think it's something that people have become a little bit maybe kind of too worried about. So that's what I'd say on the US elections. Yeah.
Great, thank you. On water, there's a question here.
Mm-hmm.
It's really around, so what are the sort of challenges, but I guess opportunities for you of the problem of water scarcity brought on by climate change?
So, I mean, I think water volatility is really what we're seeing. There is, as climate change has accelerated, you're seeing volatility of water resource. So it's not just droughts, it's droughts followed by floods, followed by droughts again. And that places a huge amount of strain on infrastructure and means, a huge amount of investment needed to strengthen infrastructure and put it on a footing that can deal with these more volatile conditions. So it means investment in water infrastructure. It means kind of better investment in storage. This is something that the UK is going to be wrestling with over the coming years as well, and it involves also more careful monitoring of where it's being used. So advanced metering, leak detection to make sure that we reduce the leakage rates in the current infrastructure. All of these things will be part of improving the resilience of our water infrastructure to these trends. So it's definitely a huge challenge going forward.
And then probably last one of these, sustainable forestry. Can you tell us a bit about that? Because I know that gets sort of negative headlines from time to time about whether it is really sustainable or not. I know we get questions about Drax here, but this question is actually mentioning Rayonier.
Yes, that's right. So our holding in the fund is Rainier, and so but taking a step back, forestry, sustainably managed forestry, we believe is a compelling opportunity in environmental markets. Obviously, the forestry assets are an important carbon sink, but it's been shown that how you manage your forestry makes a huge difference. So there are areas like Canada where the forestry was held in government hands, where they did a poor job of managing it. They had a huge amount of beetle infestations and destroyed vast tracts of forest land. So if you do a good job of it, manage your forests to the highest sustainability standards, it can make a huge difference to the health of those forest lands, their resilience to wildfires, etc. So Rainier is exactly that company. It's all of its forest lands are certified to international standards, and it does a fantastic job of managing them and acquiring and disposing of assets. So it's a very well-run business.
Great, thank you. Now then, just think about what you've said here about the outlook. So we are hopefully going to get interest rate cuts. Will that make a massive difference, do you think, to valuations in your sector?
Well, we are focused on growth investments, and we also have, if you look at the profile of the fund, we've got quite a lot of long duration assets and utilities and the like. So these are all sectors and categories that have struggled in a high interest rate environment because you're discounting those future cash flows at a higher rate. So our feeling is that as interest rates come down, that situation should normalize. So that's a kind of top-down thesis. Small and mid caps have had a very torrid time over the last years. Some people wonder if it's going to go on forever, but nothing goes on forever. No, so we think that particular size should benefit over the longer term, and we're starting to see some tentative signs of performance in the utilities, for example, which I think are starting to react to the outlook for falling rates. So I guess the question is, how quickly do the rates come down, and how does that compare to what the market expects? But having had this extraordinary period of rising rates, we're looking forward to at least being on the other side of that curve.
Yeah, great. And one of the other things we've seen in other sectors where we've got these smaller caps out of favour is a lot of M&A activity. Are you seeing the same thing?
Yeah, we are. It's very interesting. There's a long history of M&A in environmental markets in the 22 years we've been managing the trust. It's particularly been large industrials looking to gain exposure to the growth of these markets by buying out our holdings. We hadn't had any of that activity for quite a long time, but we've had two companies bid for during the second quarter. If you think about sectors, I think as I mentioned earlier on, there's been a lot of activity in the renewable power kind of project developers. So that's definitely a sign of value. And we had a name called Turner Energy, which is focused in Greece, which has been bid for. And then we also had a second name called Stericycle, which is a US medical waste player, which is being bought by Waste Management. So I don't think it's a coincidence that this coincides with a period of derating and more attractive valuations. So otherwise put, it's not only us saying that we feel that valuations have come down a long way. It's also the corporates and private equity funds stepping up and snapping up these assets. So it's quite interesting.
Yeah, great. Looking at these recent trades here, is there any kind of pattern to these? Is there any things that you're particularly excited about at the moment?
So there's a few themes. So first of all, these volatile markets create opportunities to buy really high quality businesses at much cheaper valuations. So contemporary Amprex or Cattle would be a good example of that. They are a battery technology company quoted over in China. We think it's interesting because it's a very large company. It's a dominant battery technology company. It's present across all the different chemistries. If you look at its R&D budget, it's billions of dollars. And so, you don't have to worry about which chemistry is winning out because they're involved in all of them. But it's a name that got caught in the downdraft of, China macro, a slower penetration of EVs, etc. So, also all of these trade disputes in different regions. So we did a lot of work to get comfortable with some of these challenges, but we felt with a low double-digit PE ratio, that was a really compelling opportunity to buy. So that's a name that we like. Secondly, Prysmian is another interesting opportunity in that just in terms of what they do, they're focused on the grid. They supply cables that go into the high voltage and medium voltage grid, which we think is it's going to need a lot of investment. That's what all of the studies say in order to service the electrification of vehicles and the broader economy, and to cope with an increased penetration of renewables. So that's the thesis behind that one. So those are kind of growth stories, but at the same time, we're trying to balance that by also investing in more defensive business models. So Steris is a good example of that. They provide sterilization services for the sterilization of surgical implements. So it's a very consolidated market in North America. A lot of it's repeat revenues, and again, it's less cyclical in terms of exposure to surgical procedures. But you can see the circular economy argument. So it's a balance of those two themes is what we've been looking at.
That's great, John. Thank you. We've covered a lot of ground. So we should maybe. Oh, that's very busy slide. We should maybe leave it there. But I know it's a question that always comes up, and then it hasn't been put in today, but I'm going to ask it anyway. So do you have shares in the trust?
Yes, I do.
Yeah.
Yes, I've got a significant chunk of my pension and also ISA and elsewhere. So I'm well exposed and well aligned, and it's all in the trust.
Very good. Very encouraging. So good luck with it all. Thank you very much for talking us through the story today, and we will get you on again another time. But
fantastic. Thanks a lot, James. Appreciate it.
Cool. Thank you. So we're back next week. We've got our quarterly panel show coming up. We're just talking about really the impact of the new UK government on the UK market. So that's covering, as you can see from the people that are on the panel, covering both the impact on UK equities, but also on infrastructure and renewables too. And so that should be quite interesting. Please do tune in for that. And then we've got a full lineup going through the weeks following that. So thanks very much for your time today. Have a good weekend, and we will see you next week.